Hey everybody, and welcome to the Average Investors Podcast. In today's episode, I want to talk about a few different topics. For starters, I want to tell you guys what I have my company match Rrsp directed towards and why. I also want to talk about some mistakes and tips I can go over from my own experiences. And I also want to go over a company that I recently started a position in. Now, before I kick off, make sure to follow if you're listening on Spotify and Apple Podcasts. And also be sure to drop a review on Apple Podcasts. It helps out greatly. Alright, so my company match Rrsp is where my employer matches my contributions into my Rrsp account, which is like the 401k in the States. They match my contributions up to 4% of my salary, so I currently max it out to get the full 4%, because at the end of the day, it's a 100% return right off the bat. I highly encourage each of you, if you haven't done so already, to maximize the employer match if your employer offers it. Now, my company match Rrsp is limited to about 20 different funds. They range from a variety of those that most banks would offer and be pushing towards their customers. But I chose the one that most banks won't recommend or even mention which is the S&P 500 index. Now, this index is made up of the 500 companies, the largest 500 companies in the US. So these are the companies with the biggest market cap. Now, the S&P 500 index is not evenly distributed either. So a company that is worth 1 billion and one worth 100 million in the index won't make up the same percentage of the index. In fact, the 1 billion one in the S&P 500 10 times what the 100 million one would. An example of how that works would be, let's say you want to buy a car with a friend, and the car is about $20,000. So you put in $15,000 and your friend puts in $5,000. This means that you both have a stake in the car, but the car is 3/4 yours and only 1/4 his. It works the same way with companies in the index. The greater a company's market cap is when compared to others in the index, the more percentage of that index is made up of that company. With the S&P 500 index, the companies that make the largest chunk of it due to their market caps are Apple, which makes up roughly about 6% of the fund, Microsoft, which is 5.4%, Amazon at 4%, and the list goes on and on from a larger chunk of the fund to smaller. When you look at the smallest market cap companies that make up the S&P 500, you will find a company such as Xerox making up only 0.0007% of the fund. In fact, the top 15 holdings make up over 30% of the fund. So overall, though you will find that the S&P 500 gives you a wide variety of stocks, and it pretty much touches every major industry, it is weighted. Now, you may be wondering why I chose it compared to other picks that were available in my employer match Rrsp. Well, 3 major reasons. One, which I just outlined, in its diversity, in the fact that it does have 500 companies that make it up, and touches pretty much every single sector. The second major reason is that the S&P 500 index reaps a fantastic and very reliable return. Over the last decade, it has averaged 13% per year roughly, over the last 10 years. In fact, most hedge funds can't even beat the results of the S&P 500. Most mutual funds usually do not beat the S&P 500. And it is also used as a benchmark for most investors, and most will not be able to beat it over a very long period of time. So you might be wondering why banks don't let customers know this and usually recommend other funds. So overall, the fund is reliable and has provided great returns over a long time. Well, that brings us to the third reason. That's because other funds will also charge a higher management fee. The S&P 500 index usually has a very low fee compared to other funds. In fact, from the funds offered by my company, Rrsp, this had a 0.4% MER, management expense ratio, compared to others which range from 1.9 to 2.9%. Now, even these 0.4% can be beaten by self-directed ones, which are offered by Vanguard. For example, if you want to invest in the S&P 500 and not have to think much about it, you can find that the Vanguard ones offer tickers such as VOO, which is great for Americans, and VFV, which is great for Canadians. These funds have a very low MER, at around 0.09%. They can give you all the benefits I just mentioned, plus you honestly don't have to keep up with any companies, which is perfect for those that are just looking for great returns and just want to be passive investors. I honestly think investing in the S&P 500 index, or even a good international index, is the best fit for a majority of those listening. Over a long period of time, you will make great returns, and it has a proven track record. I mean, you can just Google the returns since the 1980s. Your minds will be blown. So that about wraps up what I do for my employer-matched retirement fund. If you need any help on this, please shoot an email to theaverageinvestors@outlook.com. I'll be more than happy to give you my opinion and help. Now let's move on to the next topic. In today's episode, I also wanted to talk about some of the mistakes I've made, as I know you might have either started your journey or might soon be starting your investing journey, and I think it'll be helpful to learn from my mistakes. So I won't be able to talk about every mistake I've made, but I can highlight 3, and every now and then I'll make sure to mention some in future episodes, just so you guys can get a better idea of perhaps mistakes I've made in the near past. To start off, one of the biggest mistakes I've made was not starting off earlier in a self-directed portfolio. I had a TD mutual fund from one of the big Canadian banks for a few years, and I thought that was enough. It was one that the advisor recommended, and without doing any research of my own, I went for it. I had it for a few years, and I soon realized I wasn't making much. So when I started digging in further and realized I could do so much better, that's when I started investing by myself, with a portion going into the S&P 500 index via my employer match, and the other just from a self-directed portfolio. This completely became a game changer for me, as I still had the TD mutual fund, but within a few months, I completely eclipsed what I made from that TD mutual fund. This is when I closed that TD mutual fund and took everything into my own hands. I deeply did regret that I didn't do this earlier, and I always wish I could go back to that day and get those years back, where I could have started investing by myself a lot earlier. But I guess hindsight is 20/20. On that note, remember, it sucks to have missed out and start late, but better late than never. You have to start someday, so when you're ready, go for it. And don't worry about not starting earlier. There's always a day where you need to start, and might as well make that soon. Now, the next big mistake was not having a portion of my portfolio in cash. What I mean is having cash in my trading account. I realized that sometimes certain companies that you either have an interest in or have a stake in, it can drop in price suddenly due to some volatility. And those are the times where you really wish you had some free cash in your account. I made this mistake with companies such as Apple, where the business didn't change, but the price dropped for shares of Apple. And I wasn't able to take advantage because I didn't have much free cash left in my trading account. All of it was tied up in some companies. By the time I had put cash in though, the price shot up nearly back to normal. This mistake has cost me plenty of times in the past. So, Make sure to always have a portion of your portfolio in cash to use as sort of like a war chest in case the market has some down days. So just consider those as some Black Friday day sales. And remember, at the end of the day, if a company's price does go down, but nothing has changed in the business, it just means that the share is just trading a little cheaper now, and that just provides a better time to buy it. Now, the last mistake I have made in the past is that, well, it's probably one of the biggest ones, and it would be letting outside noise dictate some of my decisions. What I mean by that is letting news, stock picks from friends or other investors, and really not doing my own research into them. I ended up losing money, and it's pretty much just following the advice of others without really doing my own research on the companies. From investing in companies that were either pumped up to some hot tip I was told but never actually got the time to look into. And also news articles that had hyped up some companies, but they really weren't doing anything different than they were a year ago, where they were trading for a lot less. So this mistake could have easily been avoided if I just done my due diligence and looked into these companies properly before putting a single dollar in them. At the end of the day, you'd rather miss an opportunity than lose your basic capital that you have, that basic cash that you are planning on investing with. So always remember, save that downside. Remember to always protect yourself and do your research. Now, it's okay though, because mistakes are how you learn, and it's what helped me grow. At the end of the day, I'd rather have made those mistakes with less money at my disposal, such as I did then, than make them now when I have a lot more money at my disposal. The next thing I wanted to talk about is a recent position I've taken with a company called Unity. Now, Unity has been around for a while as a private company, and being a developer, I've used their Unity engine to develop for my own fun a little while ago. I did find it quite powerful and capable. I also know that the product has only grown better over time. Now, the company Unity was founded in 2004. Now, Unity is a leader in the augmented reality business that has developer tools to develop video games, virtual reality, and other simulations, such as those in movies and shows. For example, The Mandalorian show. They segmented their place by first placing a focus on mobile gaming back in 2007, when others were focusing on console and computer gaming. They focused on the newly launched iPhone and the games that are available for that in the Apple Store. Since then, they have created partnerships, and their Unity engine has been used to make some of the most powerful and biggest games in the world. They have also made strategic acquisitions in the last year as well. The technology after using it is really spectacular, as it truly has great potential in entering new segments such as modeling. For example, even car makers use it to create virtual simulations for cars. Now, the technology is really spectacular, and it has other future prospects as well, such as being used for software that architects can use to model homes or buildings and such. Now, currently, they are the biggest company in this sector, and although they have been around for a while, they only went public late last year. Now, that explains what they do in a high level, but what about the financials? Well, Unity does have a lot of cash on hand, roughly $1.7 billion. And they have low debt when compared to their cash, I think around $150 million. They also don't have any big debt due anytime soon. So they're in pretty good hands when it comes to their debt to equity ratio, especially when comparing it to cash. They also have a earnings per share loss for last year, so the year that they went public. But that's okay, as the company is growing rapidly, and it is still in that expansion phase. So especially with tech companies, you'll notice that when they're smaller and they're growing, especially when they just go public, they will have a lot more, they will be reporting losses as they're really trying to get themselves out there. For example, take the company Etsy, for example. They are reporting a negative earnings per share, but year over year it has been growing. Now, the real promise is the year over year revenue and free cash flow growth that Unity has been showcasing. The company in just the last year has had a 46% year over year revenue growth. And although it just had its IPO last year, I think giving it a few years, it will start posting positive earnings per shares. Overall, the product is amazing and the books do look good. It is a company I've been following for over 5 years, and I have used their technology myself. I didn't want to invest right on its IPO or around that time, and I wanted to let the stock kind of consolidate while I observed from the sidelines. I took my opportunity to make an entry last week, and I will look to add to it with time if the company still shows promise. So some of the things that will hinder me from wanting to put more money in is if the company's expansion and growth slows down, if they're not able to kind of replicate what they've been doing and focus on growing the technology, and also if their recent acquisitions don't really pan out so well. So that's why I did take a position into the company. But as for adding into it more, I'll really have to look and see what the company is doing. Now, hopefully this helped you guys out, and just always keep in mind that it's going to take patience with investing, and make sure to spend your money wisely because each and every single dollar will go a long way if you invest it. So remember, stop spending money on Starbucks. Get yourself a latte machine or a coffee machine and make it at home. You'll save a lot. So that about wraps up today's episode. I really hope you guys enjoyed it. Make sure to review and follow the podcast to help grow it. And send me an email if you have any questions. I'll be more than happy to answer them. Thanks everyone for listening, and take care.